Good afternoon, everybody. This is Amy Bohr from the Mortgage Collaborative. Thank you for joining us today. It is 3 p.m. Eastern Standard Time, and this is the TMC Connect session, Overlays and Best Practices, Credit Qualifying Borrowers Getting Back to Work. This is part of our ongoing TMC Connect platform, education platform, where we are doing a ton of these very relevant webinars, 10 to 12 a week, actually. We've done a ton over the past 8 weeks, and getting the best and brightest in the industry to our subject matter experts, our discussion leaders on these sessions. Also, be sure to check out our Ask TMC message board, lender only. You can reach it through ask-tmc.com, dedicated LinkedIn page, Facebook page as well. And then the third part of our the membership is our TMC benchmark, which is just real-time data. It's an input platform that generates highly visual data analytics from across the industry. Today, we have some wonderful discussion leaders for this session. We've got Jim Collier, Executive Vice President of Operations from Nations Lending. Jim, thanks so much for joining us today.
Thanks for having me again.
And then we've got Rebecca Gleffy, Senior Vice President of Risk from Nations Lending. Thanks for joining us, Rebecca.
My pleasure.
And last but not least, Kelly Hailstone, who is the Chief Operating Officer at FBC Mortgage. Hey, Kelly, thanks for being with us today.
You are welcome.
Hey, hi, Kelly. Okay, and it looks like we do have Rich that did join us today. Rich, are you there?
I am on, sorry.
Oh, perfect,
Technical, were you panicking having to run this on?
I was a little, but I was ready to give it a go. But I'm glad you're here.
I have no video, but I am
Nobody
on.
else does. Nobody else does anyway, so you're all good.
Okay, cool. Excellent. Well, want to echo Amy's thanks to our discussion leaders for jumping on. And as a lot of you know, we did a pretty expansive survey of all of our members about a week ago. Went out to about 2,000 employees at our 200 lender member companies, taking the network's collective pulse on the issues that were most important to them. We threw 17 or 18 different industry issues at the members via survey. This was the #1 issue of all of them, just in general. You know, how to protect the house essentially with overlays to credit, people now getting back to work, and more broadly beyond that. So that's what we're going to talk about today. Goes without saying at this point, but we aim for these calls to be interactive. So we've muted everybody's line, but please, we want to hear your thoughts, feedback, ideas, things you're doing via either the chat or the Q&A. And we will relay that to the discussion leaders or inject it into the conversation. So please keep the feedback coming. And as you see on the screen here, just an overview of some of the topics that we're going to touch on today. And but let's go ahead and get into it. So Kelly at FBC, you were nice enough to send me over some of your initial thoughts on some of the ways that you're overlaying credit related to income verification. Primarily, it makes up a lot of the bulk of this presentation. So I'll start with you just to get your, I guess, general overview on the topic. How you guys at FBC are treating income verifications in general right now, and then more related to a lot of America, hopefully starting to get back to work here in the next month or two.
Yeah, of course. And I'm happy to share. I mean, obviously, Mike have a great team who put together a lot of this information. Essentially, what we've done, because we haven't had a lot of direction on any special handling other than to say, hey, lenders, it's up to you to do a good job. We just sort of put together a brief summary. Deliberately, we kept it pretty generic on the different types of income that we might be dealing with from our borrowers, whether it be a base salaried or an hourly person or self-employed, all the way down to someone earning tips, and sort of put there on a matrix the baseline of what we're looking for, and then the intention for that is not that's the rule. But from them, you get a bunch of scenarios, right? And so what we've done is we started an internal FAQ with all the different scenarios in each of those categories, where as we see the scenarios or ask the question or come across and determine an answer, we're posting those FAQs within each category so that our loan officers and processors, as they are working with the consumers and come across a situation with overtime that has obviously been disrupted, or commission, or hourly wages, they can go into those FAQs, start looking through those scenarios to see if it fits their situation, and then otherwise, if it's slightly different, which so far they've all been just a little bit different, they'll post a new question that we will answer and publish as an FAQ. And so that's kind of how we've been handling it. I see in your agenda you're planning to cover a little bit about day one certainty, so I won't go into it too much, but obviously that being suspended sort of made some folks have to go back and start with those need lists all over again that they hadn't really been working up for some time. And so it's been really helpful to have those FAQs out there, sort of scenario based, so they can put together the most efficient and comprehensive and necessary needs list for our processing team.
Thanks, Kelly. And yeah, great overview of your mindset. And yeah, it sounds like you've put in place a pretty good system for the team at FBC, resources to lean on as you guys kind of go through a busy yet somewhat uncertain time. And Kelly's been nice enough to be one of our discussion leaders. We continue to lean on for calls like this. Another one of those has been Jim Collier, runs operations nationally for Nations Lending, another pretty large size independent mortgage banking firm. And Jim wanted to bring on their SVP of risk, Rebecca Gleff, which I thought was a great idea. And Rebecca, I want to start with you because we've had a couple heads of risk on these calls, but we haven't just like your world these last couple months. I mean, I guess start there and then talk to me about, from your position at Nations, this topic of just income verification in general, and then specifically related to what we're talking about here.
Sure. First, I'll say I think my world's been chaotic, as has everyone else's for the last couple of months. But I think what we're trying to do is kind of, receive the information from our partners and then digest it and deliver it in a manner that's a little more clear for our loan officers and for our processors, our underwriters. There's a lot of it. It's coming in hot and heavy, and it's hard to parse it all when you're in the throes of production. So I think the first piece of it is to kind of gather all of that, put it together. I did also, the same as Kelly released, we have an internal FAQ that we update as the new changes come out. We also have a scenario desk that's run by one of our national operations leaders, and she takes the guidance that we have and delivers it out as the questions come in, and those are also posted on our scenario desk SharePoint. So we're trying to keep it all in the forefront and make everybody comfortable with what they're trying to accomplish. As far as a perspective on how we're looking at income and borrowers, whether they're returning to work or they're on a furlough or they're unemployed temporarily, that there's a lot of different questions coming through regarding that, and I think there's quite a lot of confusion as well, because Fannie had just released in their last letter that borrowers on furlough are now no longer eligible for the temporary leave policy, which is what we were initially applying, and things like that are happening. So I think we're trying to really apply a common sense kind of approach to each individual scenario. I read a statistic that 40% of the people that are experiencing income loss are under $40,000 a year in income. So it's, you kind of have an idea of what workers aren't working and who are. So that helps as well, and I think applying that common sense approach has helped us to keep closing loans, but do it without, jeopardizing the company as a whole in terms of risk.
Thanks, Rebecca. That's a great overview. And before I go back to Kelly, I have one more question for you, Rebecca, and then one for Jim. Rebecca, the head of risk and the head of operations, that's obviously an important relationship, especially lender like Nations doing over a couple billion a year. Talk to me about like when if it's related to forbearance or some of the new changes that we've seen on income verification, like how that works. Like you guys probably immediately get together and start to think about like acceptable levels of risk and how it translates into company policies and then ultimately FAQs that you put out to the staff. Would love to hear your thoughts on just that relationship between you and Jim. And then Jim, from your perspective, the pipeline in general. I know in past calls we've talked about you had people that were locked in that maybe lost their job and different ways lenders were handling that. Now some people are starting to get back to work or see the path back to work, just interested in just from the pipeline management point of view, managing all that. But Rebecca, if you could first just speak to the relationship that you and Jim have on the risk and the operations side and how that works.
Sure. You had it. You nailed it right on the head, actually. Whenever there's something that's significant, like especially in the forbearance situation, we've kind of had to make some judgment calls there because there's not really any guidance at all from the industry yet. And so when that occurs, I'll talk with Jim and our president and CEO about my opinion of how we should approach the situation, and then we have a discussion about whether or not that's an acceptable level of risk for us. So Jim and I do communicate on a regular basis about all of those things that are changing and kind of the philosophy there. And I think at Nations we're all pretty much on the same page as far as our philosophy in lending. So it's a pretty quick conversation. It's pretty easy to move forward, but we definitely need to collaborate on that to make sure that the message gets out the right way and there's no confusion between us, because that causes problems as well.
Thanks, Rebecca. And Jim, talk to me about just general, before we get into specific overlays here, general pipeline management madness right now.
It's certainly, we're all dealing with the same situation, which is a tremendous influx of volume due to the rate environment, and then you strap on a global pandemic, and now you've got qualification issues. So we're to Rebecca's point earlier, for those of you guys on the phone, volume does a lot of things, especially in times of great volume. It exposes where you have tremendous cohesion, where your company's really working well together, and then it exposes your weaknesses. And I tell you, the relationship between myself and Rebecca, this has done nothing but really forged it even tighter. I couldn't do what I have to do without her from that relationship perspective. So those of you on the phone, if you don't have that if you're leading operations and you don't have that kind of relationship with your risk executive, that's where you're kind of missing the boat a little bit to be able to navigate these things. To Rebecca's point, a couple of weeks ago, we were literally on the phone every other day, or every twice a day, I should say, when things were literally changing by the hour, and we were having to course correct and pivot. And a lot of those conversations were, what do you think we should do? And it was a lot of this back and forth because the guidance we were receiving was so kind of nebulous. We had to draw our own conclusions, and Rebecca had to really give her opinion strongly around, this is what I think we should do and can do, and then we would operationalize that feedback. So it's been amazing for us to get to this point. We've experienced almost no real hiccups as far as that goes. If anything, it's an asset. It's proven to be an asset for us. And then with that, with the pipeline, it's me going back to her and saying, hey, if I do this from a operational perspective, what do you think the risk is? Are we opening ourselves up to undue exposure and some things like VVOEs? We bounced around the idea of, when should we layer on a 48 hour? Should we go to 24? Where should we put it? What role should do it? Should we break out a separate team that does nothing but VOEs? And if we did that, do we hire people? Do we get temps? So that's just one example of the pipeline madness of how to parse this thing down, to use Rebecca's word, to parse it down to the task. And then more importantly, once you have identified the tasks that you want to do around VVOEs or any of the other pieces of it, do you have the right role that can take it? And then what risks is associated with applying that role? I give you an example, like we should closers do it, or should we get a separate role to do VVOEs? And should we do it 24 hours away or do it 48 hours? So it's been crazy as we've all had volume, but without the partnership within the building, specifically with my risk counterpart here, we would not have gotten as far as we have come, for sure. No question.
Thanks, Jim and Rebecca. And man, it's so true. Just the push and pull, production, operations, risk, you know, being able to understand all the different viewpoints and have the right push and pull there. Such a key dynamic inside any mortgage lending operation. So, Kelly, getting back to you, and if we could go back to the slide, thank you. So listed here are some overlays that I think you have implemented, right, at FBC. It seems like everybody in the industry now, or most, is at, you know, a 24 or 48 hour final verbal verification of employment on really all loans right now, just as a best practice. But I see here on base salary, you're looking for one pay stub since back to work, and a 24-hour VVOE reflecting full regular earnings. And if the borrower has not yet returned to work, employer must confirm the return to work and that the position and the rate of pay remain unchanged. So if you could just talk to us a little bit about that, and you know, how, you know, just how you came to that.
Yeah, sure. What we were attempting to do with our back to work matrix was not necessarily create an overlay document, as much as we were trying to give everybody some guidance where agency guidelines sort of don't address it, on what we believe is sort of our minimum expectation on what needs to be there in order to confidently requalify the customer and get them back in process. So when I look at this document and when I look at the things that you have summarized here, we're kind of looking at these not necessarily as overlays, but sort of as these are the factors we're looking for in order to have someone who had some disruption to start to qualify them again. And if I could just speak to the previous conversation very quickly, we operate here at FBC with a series of committees that sort of govern each of the departments. Credit committee being the one that has sort of been meeting 3 times a week through this pandemic and through sort of all of the things that are going on. And just to echo that conversation, if as an organization you haven't put together some forum where all areas of the company can be heard, it was I think you should. For us anyway, it was a very healthy process where I think we ended up with very healthy minimal overlays that really got to the point and protected the company, but also didn't prevent new business or essentially negatively affect consumers over and above what needed to be in place sort of as a prudent overlay. So we've continued to see growth through this limited fallout. The fallout that we have has been really an application type fallout, the type of fallout you're looking for, less the lock fallout. And as you know, over the last couple of weeks, we've been able to lift a lot of those overlays that were sort of more credit related in favor of overlays that are much more make sense, such as, you know, non-liquid assets or reserves, how to refresh those and how frequently we need those types of things refreshed, things that sort of present real risk as opposed to our sort of just broadly narrowing the credit box.
Thank you, Kelly. Jim and Rebecca at Nations, what have you guys done, I guess, specific to borrowers returning back to work in terms of guidance, you know, for your staff and, you know, anything you're doing above and beyond, or to Kelly's point, to kind of clarify agency guidelines?
So, you know, to be honest, even with the VOEs, the 10-day VOEs, we're allowing the 10 days still, because at this point in the timing of the, you know, everybody's off from work, I think that we believe that most people have already been furloughed or laid off or put to, you know, they're in a position where they're already not working. So we're still giving some time on that VOE that's a little bit longer. But in terms of coming back to work, I think our biggest 2 issues were and we've addressed those. We have branch manager calls where we discuss how we're handling it, and then it's also put into the FAQ document and on our SharePoint site. But we've really just, we're following kind of the guidance for temporary leave for certain borrowers. If we've not been notified specifically that they're on furlough, then we'll allow the temporary leave guidance where they can obtain, we can get the letter saying they'll be back to work on X date, especially with a lot of states reopening, they're giving that reopening date. And so that would align with what the employer is telling us. And they'll say, the borrower will be back to work on this date at their same position and same rate of pay. So we'll follow that guidance for whichever agency is our loan is for. In terms of like base salary or overtime and tip income or bonus income, things like that, much along the lines of what Kelly had said, we want to see that they're continuing to earn that and will do so moving forward. I think that's a challenge right now because most of the people that earn those types of income are not working. So we're seeing that that's been a bit of a challenge, and we have communicated out to the field that those are unlikely to be used for qualification unless they can demonstrate with current documentation that it's still being received at the regular, at the historical rate at which it was received before. So I think the biggest thing for us is probably just to remain communicative with the field. We get their feedback on what they're seeing, and we don't just blindly make a policy or a requirement without really discussing it first with the field and also the management staff to make sure that we're meeting all of everybody's needs, but still avoiding risk.
Thanks, Rebecca. Kelly, moving on to self-employed borrowers, obviously a little bit trickier. Have here, final verification within 10 days, year-to-date P&L through end of April, and then a number of different things kind of related to proving that the business is up and running and operating and collecting revenue. We had a couple of questions come in on self-employed borrowers specifically. I'm going to throw these at you. First one is, what if the self-employment isn't third-party prepared or they don't have a P&L?
Yeah, and so this is where, and I'm not going to try to duck this question, but there's obviously a lot of follow-up questions that you then need to sort of work with your originator on. And that's where, I guess, to answer the question, but not answer it, that's where our FAQs and walking through those scenarios, that's why we thought that was important. That's why we've created that process, because when you lay out sort of a baseline, okay, here's where we start. These are the things that we feel pretty good about. If we're going to get back, get this self-employed borrower back into the process, let's start here. Then you start hearing, well, they have this, but they don't have this, or they're in this type of a business, and so what you've asked for doesn't really apply here. And we just continue to sort of work with those originators and see if we can obviously get them qualified. What we're looking to do, obviously, is just to establish that things are back. They're back to work. Some of them may not be. It may not disrupt the business totally or at all to have this happening for the last 60 days. Others, obviously, like our restaurants, which I think is what the next question is alluding to, where they're back in business, but they have to be open with some capacity restrictions. Those are going to take a little bit more review, but ultimately our goal is to requalify them wherever we can. We want to do so in a way that demonstrates that we know they have the capacity to repay. So we're going to be asking those follow-up questions and looking for documentation that leads us to that goal.
Thanks, Kelly. And I'm sure a lot of it is addressed in the FAQ, but I'm sure a lot of just direct guidance to the sales staff on things they need to do at the point of application are addressed in there. And are there a couple off the top of your head? Obviously on self-employed, some of those follow-up questions you alluded to. But anything in your head that sticks out that you've really, kind of stressed with the production team?
Well, honestly, what we're stressing is let's talk about it. We're stressing daily communication and conversation on the scenarios. And so our leadership in underwriting and in processing, who, a lot of our processing leadership have really deep backgrounds in this industry and know what they're doing, they're helping work through these scenarios and just determine if they feel like, hey, we're sufficiently back on track here. When you look at agencies' guidance specific to self-employed, it's pretty wide open, and it's really hard to eliminate, I guess, any borrower just based on what's been happening. What's the hard part is requalifying them, right? And just trying to measure or determine if this disruption has been problematic for their ability to repay. And so we try not to get ourselves too into the weeds with our self-employed customers in terms of, getting into, how were your sales yesterday or things like that. But we certainly are trying to qualify the customer much more so and make sure that we are comfortable that they have they're back to work, they're reopened, and they have an ability to repay. I mean, oftentimes we're going to be looking at more customer criteria than we are that of the business in terms of their ability to make those payments. So,
Thanks, Kelly. Moving on to our next slide here, talking about a few different components to income that affected or the potential to be affected by the general employment disruption nationally. One of them being overtime, and sometimes needing that OT income to qualify a borrower. In theory, now with companies returning to work, but a slow restart of a lot of components of the economy, tougher from a credit and risk standpoint to count on that. And Kelly, it sounds like that's what you're doing here is you need verification in writing, obviously not assuming that overtime is going to continue, but to get a written verification from the employer that it is going to continue. And then also a pay stub supporting it after they return to work.
Yeah, I mean, we're not going to try to drag it out and make sure that they demonstrate it for a long period of time. But if we can verify that they're back to work at the capacity were before and they're needed, we're going to move forward with that.
Excellent. Jim, moving to you, overtime, we just talked about. Commission employees, another challenge there because you have to be able to show the return to work stream of income, which is going to take some time. Any general thoughts or comments on, verification of overtime funds or commission employees in the current environment?
Yeah, and Rich, it really depends on, from a borrower's perspective, kind of what line of work that they're in. To Rebecca's point earlier, like tip income, folks that are in the travel and leisure, those jobs aren't coming back in earnest. And if they are, it's quote unquote essential personnel. It's typically people that are on salary, like a restaurant manager, a regional manager, a bar manager, things like that. It isn't the servers, et cetera. The cooks are obviously in the restaurants where they're doing takeout and curbside and things like that. So we're in the same boat. We would ask for something from the company on their letterhead stating, that X% of overtime, would be reasonable moving forward. But on the commission side, we're really, really looking at that at a case-by-case basis. It doesn't make sense, right? Depending on, again, what line of work they're in. If they're selling cars, for instance, nobody's buying cars right now. So the commission income there is going to be almost nothing. So it's just literally looking at it. And with Rebecca's help on a case-by-case basis, as we have situations, we might, kick it over to her group and say, what do you think? Here's what we have from a documentation perspective. What do you think? With a recommendation of either accepting it or not. And then communicating, again, to Rebecca's point, we have the standard weekly call with the branches, and we communicate week over week the examples that we're seeing from the previous week, and then issuing, some guidance from whether it's Rebecca's world and risk or from an operational perspective, how we're handling a situation. But it's some of it can be kind of blanketed. I hate to use that word. And then others, it's literally hand-to-hand combat right now.
A lot of common sense, a lot of case-by-case
Correct
assessment of situations. Yeah. The old world was underwriter gets file. In very extreme cases, the underwriter is maybe going to take something to their underwriting supervisor, but you've just explained the process that is more expanded, much more common sense, things being elevated to your SVP of risk, right? So it's kind of a different operational underwriting hierarchy today.
Agreed. And to Rebecca's point earlier, we've seen at least as far as our book goes, or where we have branches and what our origination mix looks like. We saw the initial crush of loans in process that the borrower lost, unfortunately due to COVID. They're on furlough, they're no longer working, whatever the case may be. That was the initial rush in mid to late March and into early Feb, and we've kind of worked through that. And now it's just the hand-to-hand combat of, hey, they were furloughed, they're back to work. Here's their pay stub. I used overtime, and here's what I have from the company saying this is going to be typical moving forward. And we just, it's again case by case.
Thanks, Jim. Kelly, for you, two things. One, I'd love to understand just kind of your operational underwriting escalation hierarchy at FBC. And then we had another question on self-employed borrowers asking if you put any extra reserve requirements for self-employed or any other borrowers.
Okay. So which would you like to take first? Sorry.
Let's go with the underwriting escalation hierarchy at FBC.
Sure. We're organized into teams at FBC. We have a team of underwriters with a credit manager with the authority to make calls, not exceptions necessarily, but we have an authority matrix among our underwriting, and they have the highest levels of authority given to them by credit committee. That team is aligned with a team of originators. And so generally, just inherently in the way we do business, there's already an escalation path in place. However, with respect to the temporary overlays that we put in place because of this special circumstance related to COVID, we actually set up blocks of time each day where members of the credit committee were going to be available to take scenarios and answer questions and sign off on loans that either we're up against or somehow maybe failed some of our temporary overlays. And so those were handled in 3-hour shifts among our credit committee and documented and sort of kept for us to learn from, which proved really helpful in terms of the members of committee getting a real frontline experience and understanding of what's going on and what we're dealing with. And, again, it also helped us to not go crazy with the overlays. We in particular saw a lot of growth during this last 60 to 90 days with our, we're not just a retail, but we're also a wholesale and TPO channel. And I think a lot of the reason why we're having so much success there and seeing so much growth, apart from just what's happening industry-wide in that space, brokers always find ways to meet their customers' needs. They're the best at it. And I think that they saw that we were being reasonable. They saw that our overlays will make sense and easy to talk to customers about. And so, I think that we did a good job there. And I think that was part of the reason why our folks on the credit committee got very involved on the deal by deal basis each day. And then to the second question on the on reserves, the only types of overlays we put in place around that were tied to non-liquid reserves or assets. So obviously with what's going on in the markets, we wanted to see fairly recently refreshed statement with respect to those reserves, just to make sure that they were all still there. And that's really it. The only other thing, we're not on self-employed necessarily, but the jumbo space saw a lot of turmoil. And so we did have some overlays with respect to what we thought would be reasonable reserve requirements in the jumbo space, over and above what some of the investors, those programs vary so much. So we went with what we thought was a reasonable number in terms of a reserve requirement to make a jumbo loan to someone right now, and applied that across the board.
That's awesome. Thank you, Kelly. And yeah, it is great to see, companies like both the ones we have on the line here, taking a common sense approach to risk. Back from my banking day, I remember joking with my old chief risk officer, like the biggest risk is we're going to have no loans if we keep adding overlays and additional guidelines and things. So it is a balance. It really is. So before we get to day one certainty and just more broadly, other things you guys are thinking about, from an operational and risk standpoint, I just wanted to recap some of the stuff we went through, and not surprisingly, two really incredibly well-run companies, a lot of similarities. what I heard was it's very important to communicate guidelines, overlays, clarity where there's gray areas to your entire staff, and to do so in a way that they can understand that's pretty clear. Beyond that, establish an FAQ that addresses most of the questions you're likely to get that maybe aren't directly spelled out in that guidance. 3, have an underwriting escalation hierarchy that lays out some sort of clear and transparent process by which files with some kind of hair on them are going to kind of move through the system to allow for people to make decisions, but common sense decisions that assesses risk and opportunity. And then lastly, I love this idea, something I wasn't even thinking about, was sharing the experiences from the past week or two. Like, hey, we got a file that looked like this, and this was how we looked at it. This is how we handled it. If you get one like this, this is how we're likely to look at it. So, Rebecca, is that kind of an accurate overview of the whole pie here?
Yeah, definitely how we're looking at it. Yes.
And Kelly, from your perspective, was that accurate? Kind of what I went through to try to summarize it for the listeners?
Yeah, I appreciated it. I mean, it's a lot of work, and there's a lot of people involved, and obviously having some sort of an organization and making sure people understand and know where to get that information is important. But the last one, the sharing and the oversight from a committee, or basically a cross reference of your entire organization having sort of oversight on any updates and changes to the policy, really helped us anyway to keep it lean, keep it meaningful, and quickly distribute information as we sort of found stuff of value to share.
That's awesome. I really appreciate you guys sharing that, and it's a great summary of the things you guys are doing to manage through this situation. We got about 8 or 9 minutes left. Day one certainty, obviously some changes there, temporary suspension of the reps and warrants on the income piece. Kelly, I know we've cited a couple examples here, but just interested on how that has changed things for you most critically, and some of the things that you're doing to adjust.
Well, I mean, we're those needs lists that we had built out in Encompass that we sort of scrapped for day one certainty for so long are back. They've been dusted off, and we've retrained everyone how to use them, and we're collecting those needs up front at initial application like we used to. And apart from that, I mean, that's a little extra work. It's sort of times like these where the experience that people have in this industry really shines, and you remember how valued it is. I think sometimes we get a little bit excited about things like day one certainty and automation, and times like this make you realize or remember just how important it is to have folks that understand when they have to ask for the pay stubs and the W-2s and the bank statements, and they review them and they see certain things, what they need to ask for to rectify that, so you have a clean submission to underwriting. Otherwise, you get a lot of ping-ponging of files back and forth in your pipeline. So yeah, what's old is new, I guess, during this time. Right now, it's just traditional ask at the beginning, and the better LOs and brokers are doing that, the easier time we're having with those files.
How, Kelly, has the various third-party vendors that are involved in the income verification process, has it been really backed up? Just general experience with those vendors.
There was a brief disruption with a few of them, but for the most part, we're still using them all. They still offer, obviously, a lot of value, even if it's just that information being summarized in one place with one easy request, as opposed to having to go and have conversations with the consumers and gathering it yourself. There's still value there. Obviously, we're not getting the relief, but yeah, I mean, we're still utilizing them, and they're still a big part of our.
Thanks, Kelly.
No major disruption I'm aware of, and frankly, some of them come out with some great new product around catching, forbearance and other things within in credit faster. So, we'll continue to rely on them where it can make sense with our cost structure. So.
Thank you. And then Rebecca, from the risk standpoint, full rep and warrant of income up front, that's something that's awesome for all lenders. What was the first thought that went through your mind when you heard about the temporary suspension of rep and warrants on day one certainty on the income side?
Well, I wasn't surprised. I mean, I expected that to happen. I think that the information that you get sometimes is a little, sometimes dated when you're using the day one certainty, and so I think that was something that should have been anticipated. We actually have just a few branches that use the day one certainty functions, just because we find that it tends to be a little difficult. I think our type of borrower maybe is a little bit different in that we don't have those automated verifications, and the process was dragging us instead of helping us. So we didn't feel much of an upset from it because it isn't something that's prevalent for us today. But it is something that we've been pushing to use because, those reps and warrants reliefs everybody wants that. It's just, it makes the process go faster when it is one of those easy ones. So, but I think that I think we'll see that it's probably, I know they extended the guidance until June, but I think that we'll see that they'll start to allow those again relatively soon.
Thanks, Rebecca. We got a few minutes left here, so any last questions anybody has, or feedback on things that you're looking at or ways you're doing things, please do so now. But I wanted to finish up while we're waiting to see if any last questions or comments come in by just getting both Kelly and Rebecca's opinions on outside of return to work specific related issues, just more broadly, other things, other experiences, things you're really laser focused on as it relates to mitigating credit risk on loans in your pipeline now that you're looking to close and sell. Start with you, Kelly.
Okay, wow. I mean, top of mind, top of my list every day is what's going on with loans in our on our warehouse and moving loans out the door. And so obviously we're looking for some guidance out of the agencies on closed loans and how those are going to be handled as we start to see, any in our pipelines with forbearance. But in the meantime, we're just trying to move them as quickly as possible. And right now it's getting close to month end. And so obviously managing my pipeline for warehouse capacity at month end is my biggest concern. And, day one certainty, it's not really felt or measured very well, but there is an element of that that contributed to moving loans through underwriting a little bit quicker, or at least eliminated some of the work related to clearing loans. And so, we're ahead of the pace this month. So I don't know how much that's been a factor. It'll be interesting to see. But as of right now, we're just sort of, gearing up for a big submission weekend underwriting. And so we've got a lot of folks involved right now in our underwriting teams.
And then Kelly, I know we've talked about this on past calls, but just your experience, like closed things, just the general fear that a lot of people had, when things started to change, was the general fear of events happening after the closing of the loan, but before the funding of it. You mentioned you guys are spinning them and selling them pretty quickly, but how has that experience been now that we're a few more weeks down the road?
Oh, I mean, boy, if you ever wanted to appreciate your post-closing team and see them perform on stage, you should come see ours. They, through this pandemic, coming on site, reviewing collateral and turning them and getting them out the door, and all the auditors jumping in and doing really thorough audits as quickly as they possibly can so we can get clean deliveries to agencies and get loans ready for pooling. It's been an incredible feat. And, it's sometimes you take a look at a team like that and see them step up and just, taking a minute to say thanks to your team in post-closing, wherever you are in the organization, if you can. Right now, especially, I'm sure with I'm sure a lot of independent mortgage bankers are experiencing the same growth and stress on the system, and the plane's shuddering a little bit. Our team has really stepped up, and we try to appreciate and thank them, putting themselves in harm's way, going to the office every day and turning that stuff quickly. It's been good. It's been, we've outperformed what we thought we could do. And so we really appreciate them and their efforts.
That's awesome, and so true. Like the unsung heroes, not a lot of they rarely come up in calls like this or are talked about, but such an important team, especially in this climate.
Yeah, the most, I would argue, in a lot of cases.
Oh man, without a doubt. Before I go to Rebecca to get her closing thoughts, there was one more question that came in, and it's how are you going to look at doing refinances for a borrower that has gone into forbearance but has now come out of it? We've had some back and forth on this that, most believe it's another one of those things that's not 100% clear that going into forbearance affects the borrower's ability to refi for 12 months. Is that still the way you guys are interpreting it, Kelly?
Sorry, was that for Rebecca or for me? I thought you were.
Well, I want to get Rebecca's thoughts on this too, but I'll start with yours.
Rich, why don't you get Rebecca's? Because I honestly wasn't. I thought you were asking her.
I thought you were done, right? Exactly. All right, Rebecca. Refis of borrower. Well, two things. First, refinances borrowers that are in forbearance coming out of it, and then just your kind of closing thoughts and comments.
Sure. So regarding the forbearances, that's something that's still a heavy topic right now because none of the agencies have really given clear direction on that. I've been in contact with our Fannie rep and our Freddie rep multiple times to find out their stance on it, and they've been saying for their loans, if the borrower doesn't perform in accordance with their note, then they are not eligible. So for instance, if they entered a forbearance in March and didn't pay a March or an April payment and they've gone 60 days, they're not eligible for a new loan with a conventional financing. So that's been a difficult pill to swallow because, the essence of a forbearance is that you're delaying your payments, right? And there's a hardship, so that's why you've done it. But they are still holding firm today. Now, they could be releasing new information, more to come is what I keep hearing, but they are saying essentially you're following the standard guidelines for payments. So if the payments aren't made within the month due, if they go to 60 days, 30 days is typically okay under their guidelines. 60 days or greater are not. And it's similar with FHA, they haven't released any guidance either. So this is where I've kind of made a judgment call and relied a little bit on past guidance from FHA regarding forbearance specifically for loans that, people are affected by disaster, because they do allow in their FAQs, they say that a payment missed because of forbearance is not a late payment. And that was in their old FAQs after a disaster situation. So it's not applicable here technically, and they haven't released anything to say that, but that's kind of the avenue or the direction that we've taken on FHA. And VA, we're kind of allowing the same thought process for that. But again, none of them have given any real direction. So it's a difficult thing, and it's really a judgment call by your organization to say what's their acceptable level of risk or not. And, for FHA, if we've made this determination and they decide that they're not going to allow that, we're going to have some self-reporting to do. But, that's something that we're willing to bank on, that they are probably going to follow a similar path as their previous guidance. So that's kind of how we're handling it today and just, waiting. And that is one of the things that I would actually add to my closing comments is that is something that's, I think, a big topic right now for everybody, because now we've all gotten past the parts of the employment and how we're qualifying them and when can we use their income, when can we not. But then we get to the point of, okay, now they've entered this forbearance, what do we do with this borrower? So we're requiring that they cancel the forbearance. We verify the payments were made or weren't made. We verify their payment history. Both of those must come directly from the servicer. And then, depending on the program, we'll apply the rules accordingly. So there's that. It's it's a little strange because you don't really know how to proceed without any guidance from them. So you just kind of go ahead and do the best you can. And another thing, I think in my closing, one of the other things that seems to be coming up more frequently are value issues. And I don't know if it's because we're allowing exterior only reports in certain cases, based on agency guidance, or if there's a true shift in the market as a result of the COVID-19, and that I know that there's a shortage of supply, but it seems like values are struggling a little bit, and the appraisals that we're seeing aren't, they're well done actually, and those values that are coming in are actually where they are, or where it seems they should be. So that's something that's kind of at the forefront for us today as well. But really, it's just the income and the mortgage history that we're grappling with and trying to stay in front of.
Excellent. Thank you, Rebecca. And yeah, really appreciated your perspective today. And Kelly, as always, appreciate you helping lead the discussion and be so transparent about some of the great things you guys are doing over at FBC, and also to Jim Collier, who has been on a number of these calls as well with us. So thank you all very much. Greatly appreciate your time and the discussion, which was great.
You're welcome.
Thanks, Rick.
Excellent. And thank you to our attendees. We had another nice group on the line today for this call. Coming up at the top of the hour here in about 8 minutes, another discussion that we're going to have just around starting to take some projections on what volume is going to look like this summer, and how to staff up and prepare for that. And then tomorrow at 3 p.m. Eastern, our second installment of a recurring series that we're doing on returning to the office, strategies, safety, all the things that lenders are thinking about and talking about now as it relates to getting employees back in the office and at what level. So many thanks. Appreciate everybody's time, and we'll hopefully see you again soon here on the TMC Connect Network. Take care and have a great afternoon, everyone.